Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq, with daily insight on the Nasdaq-100 index, or the NDX, which is made up of 100 of the largest domestic and international non-financial innovative companies listed right here on the Nasdaq stock market. The NDX has been the barometer for U.S. large cap growth and also one of the best performing indexes over the last decade and a half, not to mention one of the most liquid index ecosystems in the world. Now, with U.S. stocks coming into the close, the Nasdaq-100 is trading about 0.3% higher. However, it continues to outperform the other major averages year to date. Joining me with some insight, we have Shawn Cruz. He's manager of trader services at TD Ameritrade. Shawn, it's been another volatile week in trade, despite the fact that it's been green Monday and Tuesday this week. What are you looking at right now? Because even though we're getting these swings to the upside, swings of that velocity still are a bit concerning.
Yeah, and then one thing, if you look at this week, the Nasdaq has sort of lagged a little bit this week, but I think a lot of that is year to date, the Nasdaq has actually outperformed significantly. So I think this week was a little bit of a relief rally because you actually saw a lot of some of the riskier areas of the market performing really well this week, outperforming even some of those sectors that have actually led the way in previous rallies. And that I'm thinking of, semiconductors, even though they've had a strong week, there have actually been some other sectors that have not been in favor, that investors have been the most cautious around, that were actually leading the way this week. So I think it's one thing to keep in mind, though, although the Nasdaq is maybe underperforming slightly this week, if you look at year to date, they've really held up significantly better than the S&P or the Dow. And I think that's where, composition of the index and what companies are in there certainly is making that outperformance possible. So it's a pretty stark contrast in terms of performance from, looking at the Nasdaq-100 to some of the others.
All right. And let's take a look at our first two chart here. It's a little bit more technical on the Nasdaq-100. What are you taking a look at?
So looking at, in terms of what's been going on right now, it is, looking at the week in general, seeing the NASDAQ up earlier this afternoon, 5%. We sold off a little bit here going into the close. So you see pretty solid performance out of the NASDAQ. And then once again, you just look at some of these charts of the NASDAQ compared to the S&P and the Dow on the year. You see the S&P and the Dow have actually pretty closely tracked one another. And if you look at the NASDAQ, which is going to be a little bit more focused on some of these tech companies that have held up and been a little bit more resilient to some of the selling, the NASDAQ is outperforming.
All right, Shawn, let's move along to on our next couple of slides here in the energy space. The housing index. That certainly has been a focus, as everything is directly tied to the housing and lending activity as the economy essentially comes to a standstill. What are the charts confirming to you? Because if I'm looking at this today, they're actually performing quite well.
Yeah, and so I use the a lot of the exchanges housing sector index here. And the reason why is if you look at a lot of the other indices out there that are meant to track housing, they're really not tracking that direct relationship to the housing market in terms of homes being built or consumers, home buyers making the decision to go out there and make a purchase. Sometimes they're almost second order connections, especially if you look at some of the indices on the home builders, where they actually have the companies that make up the durable goods that go into those houses, but not the actual home builders themselves in some cases. I think that's one thing to look at why I like this index. This is a lot of those first order types of companies, and that is where we've seen a lot of the outperformance this week, and it actually has led the markets in many cases, and it's made up of home builders. It's made up of companies like LendingTree, a lot of other companies that make the materials that go in to build a new house, and then some of the companies that own some of the real estate for those houses as well. But it's been incredibly strong this week, and I think a lot of that is just because there were concerns around the ability of financing to be available for people to even go out and make these home purchases if they're lucky enough to still be in a position to do that. It wasn't a matter of just the willingness of the consumers, but also the willingness of the financial companies to be able to lend that money to make those purchases. And I think with all the fiscal and monetary stimulus that we've gotten over the past week, and then a little bit of optimism on what appears to be some sort of at least a temporary topping out of new cases in some of the big problem areas, I think that was enough to get people to want to come in and move into some of the riskier, more unloved areas of this rally so far. And that's why you've seen that outperformance, at least on the week.
All right, let's wrap up with our last two charts here. Looking at the oil field services group, energy really has been a big part of the story. Even before we're dealing with COVID-19 crisis, the supply and demand picture is just, it's not good.
No, and there's really been the 1-2 punch for these energy companies, and that was on the demand side with pretty much everything being locked down. Nothing's really moving around when economies slow down, so there's, just the transportation drop is going to drop the demand for oil, and that's one thing to think about on the demand side. But now you also had Saudi Arabia and Russia getting into a little of a spat over the number of amount of oil that they're going to be pumping. As you've seen that start to escalate, and Saudi Arabia finally said, we're just going to flood the market with oil. You had the price of oil get hit from a demand shock in terms of no demand, and then also supply shock of too much supply coming on the market. That really pushed oil down to that $20 per barrel level. And when you think about how far we've come, at that point, when oil was down around $20 a barrel, and it actually broke slightly below that briefly, there was discussions around we might very possibly see $10 oil. And if so, that would have some pretty devastating effects for many areas of the oil market. And the reason for that, I think, to be exacerbated was that there's also a lot of debt, which was already something that a lot of investors were focused in on coming into the end of 2019, was a lot of the debt that was coming due in the oil sector here in 2020, if they were going to be able to roll that over or find new financing. So what you saw now is you had the oil services sell off nearly 60% just from the start of the year. So that was really where a lot of the selling was strongly focused. I think with a little bit of a recovery in the price of oil and some of, again, once the fiscal and monetary stimulus that we've seen, you're getting a sense that maybe the worst case of just widespread defaults in the sector is getting pulled off of the table. And that's why you're seeing some investors come in and saying this isn't going to be an industry that just sees default after default, because if you default on your bonds or your loans or anything, the equity gets wiped out almost always. That's almost always the case. So I think some of that worst case event is being pulled off the table. And so although you're seeing a recovery and strong performance on the week out of some of these names, keep in mind that on the year, they're still under significant pressure and still down as a sector over 60%. And that's something to keep in mind, because one thing we heard from today, if you just look at ExxonMobil, came out and said they're going to cut CapEx. So CapEx for the oil producers is actually revenue for the oil services sector. It's something to keep in mind that as you're seeing a lot of this come out, that's not good news for a lot of these oil services companies. And that's why I thought it was interesting on a day where Exxon comes out and makes that 30% CapEx cut announcement, you still saw oil services rally. And I think that's something interesting and something to monitor moving forward.
All right, Shawn, great insight as always. Thanks so much for joining us.
Thank you.
All right, thanks for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.